webinar, the Union Budget 2021-22, Indian Economy, the Way Forward. On behalf of the NCube collaboration, as an advisor, I also extend a hearty welcome to all of you. As all of you are aware, NCube collaboration is a think tank organization engaged in transmission of knowledge by doing a webinar, conference, workshop, training and all in respect of banking and finance in the capital market and debt market, as well as NBFC and CSR and other area like IBC, international trade, or an Indian economy and other important subject. And all of you are aware that we had during this COVID had organized some more than 10 such webinars, and I'm very glad that all of you have overwhelmingly given the response, and all these what you call video recordings are also available in the YouTube of NCube collaboration. And today we are very fortunate that we have a very esteemed panelist with more than 250 years of experience. And it is really a combination of a regulator, as well as the banker, as well as the analyst and the rating agency, and also from the corporate, as well as from the individual professional practitioner. So it is, as far as the budget, all of you would have already had quite a lot of information. But today we will be receiving very critical analysis, and also what is the medium and long-term impact and positive impact on the Indian economy. So it will be very interesting for all of you to hear from this esteemed panelist. I especially acknowledge the presence of Mr. Anand Sinha, Deputy Governor, former Deputy Governor, Reserve Bank of India, and it is our we are privileged that today he is going to give his inaugural address with his vast experience both domestically and globally, and with the knowledge of handling regulation of banking, NBFCs or cooperative bank, and in attending the international committees, forums like BIS and other G20 and so many other areas where he has represented Reserve Bank. And today also he is very active. He is also helping World Bank, Asian Development Bank, and some of the leading practitioners in financial consultants, and he is keeping his day very busy. So we extend a hearty welcome to Sir Anand Sinha Saab. And similarly, we have Dr. M. Subhada Rao, and all of you are aware she was working as the chief economist and senior vice president in Yes Bank, and after her service of a long period there, she has now started. She is the co-founder and the founder actually of the new organization called Contact Eco, an independent analyst group, and provides very macroeconomic and other sectoral analysis to corporates. And she has worked in various earlier also Kotak Securities and similar maybe ICICI, Kotak Security, CRISIL, and Bank of Baroda also, public sector bank like Bank of Baroda and Times Bank. And with her experience, he has also represented in global various central bank and presented India global story there. So we will, on behalf of the NCube and other our facilitator and our Lions, I extend a hearty welcome to you, Madam Subhada Rao. Yeah, and we have Mr. Anant Narayan. All of you are aware he is a great market practitioner, and he has worked in a very senior position as the MD of Standard Chartered Bank, both domestically and globally. He has worked in forex, domestic, and the overall integrated market. He was also the, I think, vice chairman of the FIMDA, FEDI, and after that, recently he has joined the one is of course the observatory group, as the senior analyst and also in the teaching profession as assistant professor of SPGA EMR, and he's has been selected specially as the director of Yes Bank, and he's also in other few boards, and he's in the SBI SEBI Mutual Committee Advisory. His biodata is very vast. Today is found everywhere, almost in all webinar conference, and he's a frank person, gives his suggestion to the government or everybody. And on behalf of the NCube and all think tank webinar as well as our Lionism, I extend a hearty welcome to you, Anant Narayan. Yeah, and we have Mr. Kannan. He will be joining at 4:30. All of you are aware he is the former head corporate performance monitoring of the Hinduja Group, and after that stint, of course, today he is not only a consultant. Just in 6 months back, he retired. He is also teaching in the various universities and management institutes. He has worked in TCS, PwC, ICICI Infotech, ICICI Bank, and he is also in the various industry committees of the industry association. So I extend a hearty welcome to R. Kannan. We are very young and energetic, and we have Deepti Deshpande. She is the senior economist from CRISIL, and she has, I think, more than 14 years of experience in the CRISIL, and she works very closely the CRISIL research, and she interacts with the external stakeholders of the CRISIL in giving a macroeconomic aspect as well as the other what you call rating agency perceptives on the global economy, Indian economy, and the very sectoral aspect. And she has also worked in Edelweiss Financial Services and also in CARE rating on behalf of the NCube collaboration and our think tank webinar knowledge series, as well as our Lion International. I extend a hearty welcome to you, Madam Deepti Deshpande. Sorry, welcome. And we have a very knowledgeable, very chartered accountant of leading professional, and Mr. Sunil Goel, and he is the founder and MD of Creston SGCO. This is advisory LLP. It's an international organization and ranking very high in the international consultancy organization. And he had also his own another, he's the founder of Ladders Group, and they are dealing with a lot of leading corporates and medium mid corporates, and provides extensive professional services, and they are having more than 300 professionals. And also he was the chairman of the Western India Regional Council of ICAI-IIRC, which is a Bombay-based Western Region Institute of Chartered Accountant Council, very active. And it is our that with the mostly on the taxation and other sectoral analysis and other things he will be talking. I extend a hearty welcome to you, Sunil Goel. Yeah. So friends, all of you are aware, since we have the guest, it would not be prudent for me to talk more about the budget. But one thing is certain, this year's budget is, as rightly mentioned, is coming in the backdrop of Atmanirbhar Bharat. And the COVID-19 right from March onwards, with the lockdown and all, and with the large contraction, and later of course 7.5 contraction by September, and very quick recovery, and expected that overall contraction also maybe in that range. And in that backdrop, and in the Atmanirbhar 1, 2, 3, 4, more than 24 lakhs of what you call package, and also structural reforms, and parallelly Reserve Bank more than 12 lakh crores of liquidity infusion, as well as the what you call your regulatory forbearance. In the backdrop of that, this budget has been a very transparent budget, and this is also a budget of big bang reforms. Some of the far-reaching changes, like opening up the even public sector bank for privatization, opening up the insurance sector, because if I mention all that, then our panelists will have to have coverage of that. But on the 6 pillars, as well as in terms of more focus on healthcare and well-being and the clean water, followed by infrastructure push, whether it is in road or it is in railway, port, shipping, or energy, power. In all that, the focus is on what you call capex, and that's why the large capex of 5.54 lakh crores, and the financial sector reforms are really a game changer and covering vast variety of places. Then similarly on the what you call strategic and non-strategic PSU sale, the policy which approved, and in the overall, it has raised quite a lot of appreciation for our honorable Prime Minister as well as honorable FM. And of course, today the most important point is in execution, how the execution at the earliest, and how to also manage the large central and state government. With this small introduction of the subject, I am sure that all of you who have come in large numbers will be benefited. And now I take pleasure in welcoming Mr. Anand Sinha, our former Deputy Governor, Reserve Bank, to give his inaugural as well as the opening address. Governor, Deputy Governor Anand Sinha Saabji. Yeah.
Thank you.
Yes, sir.
Good afternoon.
Welcome, sir. Welcome.
Thank you.
Yeah. Yes, sir.
Good afternoon to all the participants and panelists. So let me, I mean, the topic is extremely vast. So obviously in the short time, one can only touch on some points, and that's what I will do. So this budget has come at a very difficult time. The economy was already on crutches in the pre-COVID times, with sharply declining growth, declining investments, and the financial sector, particularly the public sector banks, saddled with very high NPAs, inadequate capital levels. And when I say inadequate capital levels, I do not mean that they were not meeting the regulatory requirement, but why I'm saying so would be clear slightly later. And the system was facing corporate frauds one after the other. The NBFC sector was also seriously hobbled after the ILFS episode, and getting financing was becoming a serious problem for all except a few. And then came COVID with its devastation of lives and economies, which has engulfed the entire world, unlike the global financial crisis. In fact, this is a bigger crisis than the GFC. The government tackled the COVID crisis with Atmanirbhar Bharat packages, including measures taken by RBI, estimated at about rupees 27.1 lakh crores. That is about 13% of GDP. However, this had very minimal fiscal cost. While RBI's efforts were focused on providing ample liquidity with a view to lowering the funding cost and facilitating credit flow to certain productive and certain stressed sectors, as well as lowering the cost of government borrowing and enabling banks to invest in government securities by relaxing the held to maturity criteria, easing the regulatory burden on banks and entities by way of moratorium, one-time restructuring facility, and deferment of implementation of certain Basel III provisions, etc. Government efforts were largely by way of non-budgetary provisions of guarantees on liquidity, equity, etc., with a view to enable entities to continue functioning, and hoping that this will also provide relief to the households. It doesn't mean that government didn't provide direct help to the beleaguered people. They did, but the major thrust was on the entities, on the firms. The budget follows the same approach, that is, focuses on supply side measures and not directly on the demand side measures. It will be useful to see very briefly how the other countries responded to the COVID crisis. Budgetary measures in advanced economies were more than that during what they had employed during global financial crisis, and it reached 5 times than that of emerging market economies in the present crisis, which is just 2% of GDP, which means advanced economies went up to that is the budgetary provisions were in the range of 10% of GDP. The advanced economy measures also included direct income support by way of various schemes, such as furlough schemes, which help hold up employment. The other difference was the banking system was much better capitalized going into the pandemic, including going into the pandemic, largely due to the post-global financial crisis reforms, as a result of which they could draw on the capital buffers to keep credit flowing. As per a BIS, that is Bank for International Settlements report of May 2020, banks globally entered the COVID-19 crisis with roughly $5 trillion of capital above their Pillar 1 regulatory requirements. As per their survey of about 5,600 banks globally from 142 countries, the common equity Tier 1 capital ratio was 14%, whereas this was 11.7% for the Indian banking system, even while carrying a large baggage of NPAs and potential NPAs. Now, in this 11.7%, there would obviously be skewed distribution of capital ratios, and therefore some of the banking segment was seriously hampered. Now, the point is that today, particularly after the global financial crisis, capital or adequacy of capital is not judged merely based on the regulatory minimum, but is based on essentially carrying out several other exercises, collectively known as Pillar 2 exercise. And if for 5,600 banks globally from 142 countries, the Tier 1 capital was 14%, then you can
सिन्हा साहब आपका वॉइस थोड़ा इंक्रीज करिए और नजदीक आइए. Yeah, it's okay, sir. Now you have to.
Just one second.
Yes, sir.
Can you hear me better?
Hi, now it's okay, sir. Yeah.
Okay. So you can imagine that a good number of them would have had Tier 1 capital much in excess of 14%. Now, why I am emphasizing this point is that this indicates the need for reforms, because government with its limited fiscal capacity cannot really very aggressively recapitalize banks. For example, now you have seen the budget provides for 20,000 crores. Now that's not really a large enough sum for the banks to be able to operate very freely. In this backdrop, it can be clearly seen that the Indian economy and the financial system have required serious structural reforms even prior to the onset of COVID to ensure a significantly higher growth. It would be sobering to note that even with the projected nominal GDP growth of 14.4% in financial year 2021-22 after a contraction of 7.7% in financial year 2021, the economy would just be roughly of the same size as it was at the onset of COVID, which means a year of growth has been lost. And even if we assume that the economy would have grown by a very modest 5% had COVID not been there, it will still take years of sustained growth to recoup this loss. So we have, like other countries too, a lot has been lost economically, and making it up in a short time is a very, very difficult task. COVID has thankfully hastened the process, and the government has grabbed the opportunity to push through meaningful reforms, particularly in the financial sector, as reflected in the current budget. As they say, never waste a crisis, and the government certainly doesn't seem to be in a mood to waste this crisis. The guiding philosophy appears to be, and rightly so, that government should only be there to provide public goods and address market failures. The proposals are a move in that direction. The other hallmarks of this budget are, number one, a laudable move towards transparency by bringing in the off-budget food and fertilizer subsidies above the line, which will help build trust. No doubt, this has pushed the budget deficit to a higher level of 9.5% for financial year 2020-21. But the step is clever too in terms of timing, as a COVID ravaged world has greater tolerance for comparatively higher debts and deficits. And two, care and conservatism in projections, which again is trust reinforcing as well as good economics. To resist the temptation to raise taxes for raising resources is another very pragmatic move, as the demand constrained economy would have been spooked if disposable incomes would have been reduced. Coming to some of the specifics of the budget, it focuses on supply side, as I stated earlier. It appears that the government has waited for the massive fiscal push till COVID comes under control and the lockdowns are no longer required, as well as for the vaccination program to be underway. Growth being the focus and considering that private investment remains subdued, the only way for government is to do the heavy lifting and in the process hope to rekindle animal spirits and crowd in private investment. This is not the time for fiscal conservatism, but at the same time, a balance is to be struck to ensure that the expenditure is in the sectors which have high fiscal multipliers and high employment intensity. The government has in this pursuit rightly chosen massive public investment in infrastructure. The other areas of higher spending are in education, healthcare, nutrition, and urban infrastructure. The conservatism is indicated by the fact that whereas the economic survey has projected a nominal GDP growth of 15.4% for financial year 2021-22, the budget has taken it at a full 1% lower at 14.4%. The total expenditure increase in financial year 21-22 is budgeted at less than 1% from the revised estimate for the financial year 2021. The revenue expenditure is estimated to decline by 2.7%, and the capital expenditure growth is pegged at 26.2% to rupees 5.5 trillion. So we can clearly see a shift in trying to curtail the expenditure which is not productive, and to divert more resources into asset building, and hopefully which will generate employment. With no appreciable increase in taxes, the financing is to come from disinvestment of rupees 1,75,000 crore and asset monetization, such as toll roads belonging to NHAI as well as to other government undertakings. Coming to the financial sector reforms, there are proposals for privatization of 2 public sector banks and 1 general insurance company, set up of a to have a lending portfolio of at least rupees 5 lakh crores for this DFI in 3 years' time, setting up of a reconstruction company limited and asset management company to consolidate and take over the existing stressed debt, manage and dispose of the assets to alternate investment funds and other potential investors for eventual value realization, recapitalization of 20,000 crores for public sector banks, IPO for LIC, and FDI limits to be increased from 49% to 74% in insurance. The details are not yet worked out, so commenting on these proposals is difficult at this stage, but certain generic comments can be made. That is, in all this, the design and execution is extremely important. Otherwise, we have seen so many things which have been going on so many attempts have been going on in the economy, but they have not really succeeded. Look at the disinvestment in Air India, look at the farmers' agitation. So from a design perspective, how will the public sector banks be selected? Now the question is, obviously what the market would expect and what the government would want to do would not really be on the same plane. The government would obviously want to do away with or privatize those public sector banks which are weak or which are in a weaker situation, and markets may not be really ready to take them on, and therefore a proper selection so that the privatization goes through is extremely important. As far as the capitalization part is concerned, I have already mentioned that 20,000 crore does not amount to aggressive capitalization, and therefore reforms on public sector banks are extremely important. While privatization has made a beginning or is supposed to make a beginning, uh, we can assume that the public sector banks, particularly the larger ones which have been consolidated, are going to stay for quite some time. But there has to be a move for reforms. Sadly, there is no mention in the budget about that, and the blueprint, very good blueprint, is available in the form of PJ Naik's report uh, within the constraints of government ownership. But neither there has been any significant progress on that, nor there is any indication in the budget about that. DFIs. Now, the idea is to create a new institution, and the IIFCL will fold into that. So the question arises, if it is to fold into IIFCL, which has not really been successful, then what are we trying to achieve? And therefore, it is very important that the other aspects as to how efficiently this new DFI can function should be looked into based on the past experience. The failures or the deficiencies in the earlier DFIs were governance related, were funding cost related. They were getting subsidies in various forms, both from RBI in terms of long-term operational funds and the SLR status for their bonds, which are no longer there. And of course, there were and continue to be many external factors because of which the projects get derailed. For example, uh, judicial decisions. Then you have clearances not coming in time, court cases, etc. Coming to, so again, the design issue becomes very important. In fact, personally, I feel that the DFI has to move away from government ownership. It should be in the private sector with substantial government presence, which will serve both the purposes, but should be in the private sector, so as to have freedom of action based on commercial consideration. This can be achieved even if it is in public sector, but we haven't seen any evidence of that so far. So that is why I'm skeptical on it. The ARC and AMC, there will be no government equity. Again, the same question arises, will it be in public or private sector? If it is in public sector, will it not be hobbled by the same constraints by which a public sector bank is constrained today? There is also talk of government support. Maybe if the ARC's fundraising instruments are guaranteed by government, or some support is extended by government, it will be easier for them. So anyway, basically we have to wait and see what are the details. But from a design perspective, I felt that these are some of the very crucial issues that will have a bearing on where finally we go. In all these proposals, not only the financial sector related, but also in pushing up the infrastructure construction, in divestment of a very large amount of 1,75,000 crore, monetization of assets. The execution risk is very high because the past does not give us confidence that all these things can move with the required speed, and therefore the execution risk needs to be handled very robustly if the intent of the budget is to be achieved. In fact, I would say that a lesser budget with better execution is better than a very good budget with serious deficiencies in execution. So let us hope that execution would be taken care of. The other risks is certainly from a macroeconomic perspective. Today, there is a coordination between fiscal and monetary policy to reduce the cost of borrowing of government. In this kind of situation, it is a very legitimate objective. But the government's high borrowings did scoop the bond market, uh, followed by RBI's intent of liquidity withdrawal by hiking CRR, notwithstanding governance assurance, and in the absence of bond buying calendar. So RBI will have to continue to be on this path, that is providing, keeping the yield curve, the long end yield curve down. But difficulty will arise if inflation picks up. And there are not insignificant upside risks uh, on inflation due to oil and metal price increases. And as the economy improves, and as the global economy improves, which is projected to, I mean, barring a very severe second wave of COVID, to 4.3% as projected by the IMF, then in that case, the input prices will increase. If the demand increases in Indian economy, the pricing power of the firms will increase. And we have seen already that the core inflation is quite stubborn. Uh, and even though the saving grace today is that we have large spare capacity, but nevertheless, if the demand improves, that capacity can be utilized in comparatively shorter time. And if we don't have the infrastructure and other projects uh, in the meantime, while this capacity gets used up, then there will be inflationary situations, and then Reserve Bank will have a very, very delicate task to attend. To sum up, what could the budget have done better? Well, I will not treat it as a grudge, because the resources being limited, or the deficit financing could go only up to a certain level, not without cap kind of thing. So I would not criticize that why these things have not been done, but I would simply mention that these are some of the issues which are not very comfortable from budget perspective, like status quo in defense when we are facing uh, trouble on the borders, spending cut in PM Kisan income support scheme when we have farmers agitation. We have agriculture and development cess with lower basic duty to compensate, but this is going to raise the hackles of state governments whose divisible pool will go down. The PLI scheme probably could have been extended to more sectors to give a greater boost to manufacturing. Vaccination for that, 35,000 crores have been budgeted, doesn't seem to be adequate. And while a purse of 44,000 crores has been given to DEA to be able to supplement the funding requirements of infrastructure projects which are making good progress, but do need more funds. At least there is no explicit mention of how to deal with incomplete infrastructure projects. Thank you.
Thank you, sir. And really very thought-provoking covering entire gamut. And we will come back to you later, sir. Can I request Dr. M. Subhadar Rao to cover
Yes.
opening remark? Yeah.
Yeah.
Your colleague would have come. Yeah.
Yes, Yuvika is here. Thank you, Ncube Collaborations and Narendra sir for inviting us to share our thoughts on what the union budget entails. The task is daunting, not from the budget point of view, from the session point of view. You are asking us to run a marathon at a speed of a 100-meter race. So we are going to try our best to do that. So over the next 10 odd minutes, the whole idea is to give our take on the budget and how does it feed into the macros over the near term as well as the medium term. The whole idea is what was this budget expectations all about? Clearly, the backdrop was extremely challenging, and the expectations proportionately were exceedingly high from the union budget that was to get announced on 1st February. And to a large extent, it did take a lot of boxes of the laundry list of expectations, in our opinion. And the 5 key distinct factors that we liked about the budget, some of it were alluded to by Sinha sir, but clearly one was obviously transparency and credibility. That was the first thing that did take some of the market participants by surprise by the extent of fiscal deficit announced and the consolidation path thereby. Second was the whole thrust on investment-led growth, which was more of a medium-term tone, rather than just instantly addressing the very, very near-term concerns that is of inducing significant thrust on consumption. So we liked investment versus consumption. We liked the capex push vis-a-vis revenue expenditure push. We liked the entailing of job creation and not the emphasis on SOPs. And of course, as Anand Sinha has adequately and more than sufficiently covered the financial sector reforms, need of the hour. At this juncture, we would like to introduce you to a few of the slides which Quantico Research and my team have set forth. So Yuvika, if we can quickly share the screen, that would be great. So if we could go to the slide 2. As I said, a lot of these, there were a lot of ticks on all the boxes of the left hand. That's the hits, which I just spoke about. What were the misses? Very clearly, it entails, as Mr. Sinha was also saying, a huge government borrowing, and what would it do in the end to the government borrowing and keeping the cost of borrowing fairly reined in. The next slide, please. We'll run through some of the pleasant surprises. As we said, that a lot of transparency was embedded into it in the numbers. The whole food subsidy, large extent, came on through budget provisioning rather than keeping it as extra budget and outside the budget borrowing. So right from 1.3 trillion, it had gone to 1.9, and what it is getting budgeted for is actually dropping to 0.3 trillion, that is 30,000 crore. That is a significant shift from all the years of keeping food subsidy bill through the NSSF and Government of India service bonds outside the budget reckoning and math. We liked this about the budget. The second, why we say is conservative, is by a large measure a 14.4% national income, nominal income, looks, in our opinion, slightly understated. If you look at the projections of tax revenues, particularly, we believe that the tax revenue collections, the gross tax revenue collections of fiscal 22 have been kept at 6.9, whereas we believe that as growth improves, economic momentum improves, this tax to GDP ratio is set to improve. A lot of row items within the budget calculations, we believe, are slightly on the conservative side. But of course, we have to see that the V-shaped recovery continues with the ascent as it is. The next slide, please, would be more on the fiscal deficit number, which was, to quickly explain, why was this real? There's out of a 9.5 declared for the year fiscal 21, it would have been a 7.9 if the transparency had not brought in. With the transparency, it has pushed to 9.5, but because of the food subsidy coming on to the budget, it got pushed. Excluding that, if it had continued as is, where is since last few budgets, the fiscal deficit would have been 7.9. So we need to take comfort that there's no uncertainty, there are no hidden items. And from here on, we are going to move to a more transparent budget making, arithmetic wise, of course. If you look at the projection of fiscal 22, 9.5 being brought to 6.8, the 270 basis point correction is, out of which 110 would be on account of the food subsidy bill. So we know that progressively the consolidation path is very much getting set, and our opinion is that going forward, this consolidation process should hopefully, with execution being the key, as Sinha sir did allude to, execution being the key, we will see, a larger government spending push for infrastructure, health, well-being, and so on, embed growth impulses. The next slide, please. Would be the next item that we saw was the push to the financial reforms. I will not spend too much of time there because a lot has been already spoken, but we do like a change in the government mindset. And one of those things that I would like to highlight is very, very clearly, privatizing two public sector banks. To me, that is one of the bigger change in strategy of the government that we have seen. The next thing that I would also put attention is on the DFIs, where we welcome the long-term financing platform being set through a creation of DFI, or rather I should say revisiting the creation of DFI. Important would be how are we going to fund it? The liabilities will be important. While we are creating long-term assets, but liabilities, probably we could look at garnering global capital to fund the DFIs, be it pension funds, be it sovereign funds, sovereign wealth funds, but it's going to be important to perhaps lean on not just domestic savings, but equally important to lean on some of the global savings, global capital to fund and to provide the seed capital for this DFI creation. The next slide, please, would be more on the fresh take of CAPEX. What we like is the mode. Earlier, it used to be just a debit and credit entry, in CAPEX creation. But what we like is, of course, not just the creation of DFI, but the National Asset Monetization Program, issuance of zero coupon bonds by the IDFs, and more importantly, FPIs being allowed, foreign portfolio investors being allowed for debt financing of InvITs and REITs. The whole capital thrust is going to be, if you look at the allocations, it's going to be on communications, it's going to be on urbanization, and of course, capital injection in the public sector banking space. But the entire thrust is going to be, if you look at sectorally, is going to be on infrastructure and on health. And that, we believe, a CAPEX multiplier is far significant. If you look at the GDP output multiplier, CAPEX multiplier is 7 times more than the revenue expenditure. And we believe this is what is going to be a growth embedding push and a welcome shift of the government's strategy to look at not just the near term, but also the medium term growth. The next slide, please. Just to give you an overall view that we are still living in an uncertain world. There is a second wave globally of COVID, but what fortunately and hopefully is containing it is the vaccine rollout globally. Also, we have seen the pack being led by Israel, the UAE, the rest, some of the oil economies like Bahrain and so on. So vaccine rollout, the speed with which the population is covered is going to be very critical to maintain or to mitigate rather the COVID risks that may emanate out of the second or the third wave possibly. But this is an active risk that we continue to monitor coming from the global side. The next slide, please, would be zooming out of the budget. How does all this play out for our growth projections? There are 3 scenarios that we created with the vaccine rollout and the Q4 of this ongoing year, that is this current quarter, where we have seen a high frequency indicators giving confidence that the growth is definitely on a much smarter recovery mode. Given the probabilities of the 3 scenarios scenarios that you can see on the screen. We believe that the largest probability is of the scenario 1 playing out with the vaccine rollout, with no second waves returning to India. Fortunately, they haven't with that intensity. Given that, we expect the GDP growth to clock 11.5%. Fair bit would be base effect. Obviously, no prizes for guessing. It's a no-brainer. But importantly, the second half of the new fiscal year, we believe that momentum will start picking up. Sequential momentum will start picking up as some of the reforms start feeding into the growth impulses, not just for the manufacturing sector, but more importantly, for the services sector, which saw a really deepest sharp cut. We believe that there's going to be a stronger rebound and a much stronger resurgence in the second half of the fiscal 22, emanating from services, which forms a larger share of our GDP. So we believe out of the three scenarios, scenario 1 is where the highest probability lies. But what about the medium term? Into the next slide, we will see that while COVID has definitely, set the projections much lower. Why is it so? Because we've seen some kind of a permanent loss of output. And this chart amply puts in place the kind of scope that we could have had in terms of average real GDP growth if COVID had not struck us. But post-COVID, where are we settling in basis those three scenarios that we talked of? And we still go with the first scenario of the probability being very high. Even despite that, we do see a loss of output of almost 8 to 9%, which will be tantamounting to a setback in your GDP, in your real output. Of course, as we move between 21 to 26, this 8.8 may become a 7.5, but more importantly, the fact remains that post-COVID, we are definitely seeing a semi-permanent loss in output, which this chart very beautifully and amply explains in our opinion. The subsequent one, post-growth, is where do we see the inflation scenario. So where are we seeing inflation? Inflation post-COVID, because of the deepest supply shocks, it was more of supply disruptions that pushed the inflation significantly higher, well above the 6%. But what we see is in the recent months, we are seeing the inflation headline coming and converging more towards the 4% mark. There are risks. There are risks because commodity cycle is moving up. Commodity prices are moving up. If you look at CRB index, there it's going to be very critical, however, in our opinion, that RBI remains packed, even in the new MPC framework, to go towards a 4% central tendency rather than get, of course, the committee would decide it, not just RBI, but we hope that the committee would look at a 4% as a central tendency. Where do we see COVID? And given the backdrop of, COVID, we've seen that there has been a kind of a COVID intense impact, the items which were really suffering. And how have we gone about it? We've just plotted the July to September average of inflation momentum, sequential momentum between July and September once the COVID hit. And we have compared that with the preceding 6 years of average between July and September. And the items which have shown significant, increase in that momentum are what we are defining as COVID-sensitive items. And this is where the chart tells you, of course, there's a discontinuity between March and April, May inflation numbers, but we believe that these COVID-sensitive items going forward, once the supply disruptions are eased sequentially, we could see inflation come off, but on an average, we could still see a 5% inflation in fiscal 22. Crude oil prices and other metal prices would continue to provide risk. This also tells you a story that with the permanent loss of output, some of the MSME-related items have seen supply getting disrupted for a slightly longer duration. As a result of it, we may not see easing of inflation very quickly. But as I said, it's going to be monitored and looked at more closely as we progress into the subsequent months and quarters. I think at this, we probably will get Yuvika on board for the next 4 or 5 minutes to take you through some of our market calls in terms of USD, in terms of INR, and in terms of rates. So over to you, Yuvika, very quickly. Thank you.
Thank you, Shubda, for setting the backdrop. What I will do now, I will take forward from where Shubda left and offer you our thoughts on where we think markets in terms of currency and rates are headed. Now, if we step back and look at the global scenario, we find that over the course of last 1 year, at least since the time the pandemic struck us, unprecedented degree of policy support, both from monetary authorities as well as fiscal authorities, has taken shape in the global economy. And this has come at a time when the support from the QE platform also has risen massively. So if we were to compare the amount of quantitative easing that the key central banks have done, we find that the total amount of quantitative easing is almost 7 times of what we saw in the period after the global financial crisis, which was also to be mindful of that it was a QE over a much prolonged period of almost 6 to 7 years back then. But now, in a very short span of less than 1 year, we have seen a lot of pump priming happening in the global economy. If you look at rates, they are near a record low. And from a fiscal perspective, we have seen a sharp swelling in the balance sheets of the government. So what does this mean for India? From India's perspective, Shubda alluded to our views on growth and inflation. I think we need to keep in mind 2 things. One, like Shubda mentioned, a large part of the technical bounce back that we expect in the 11.5% of GDP growth in FY22 is because of the low base. But we also have to be mindful of the fact that there will be a fair share of organic growth that will take shape as we head into the next year. We already see that in large number of lead indicators, which are now almost close to or inching back close to the pre-COVID levels. Second, on the inflation outlook, while in the last 2 months of data that we've seen for the months of December and January, with inflation coming back into the comfort zone of RBI. But if you look at it from an average perspective for the entire year, for FY21, we are still at a 6.2% average for the year. And for next year, while we do expect some softening of inflationary pressures, it will still be close to about 5%. That is above the 4% mid-target of the Reserve Bank. Now, we have to also keep in mind that inflation expectations are also close to double digits, which reflects how households are perceiving inflation over the course of the next 1 year. And mind you, this is against the backdrop of high retail fuel prices, which are almost close to record highs. Now, against this inflation growth dynamics, we feel that there is a need of some degree of normalization in policy that should happen. And in some sense, RBI has already indicated this. And as I will also argue, that the government's budget also reflects some degree of early normalization, if I could call it so. And
Madam,
I think the authorities...
Madam, time is over, or any further slide, because the time,
no, we will have two more minutes, Narendra sir.
Yeah. Okay, please.
Sure. And somewhere we need to keep in mind, and I think the authorities also have it at the back of the mind, that as soon as the vaccine rollout achieves critical mass, activity levels are going to shoot up dramatically. So what does this mean from our RBI perspective? We think RBI's moves will be largely baby steps over the course of the next 1 year. The first line of action, in which we have already seen, will be on withdrawal of surplus liquidity to some extent, so as to be able to align the short-term market rates with the monetary policy rates. Second, we believe that the accommodative stance will continue through a much part of this calendar year, that is 2021. It will only be towards the end of this year, somewhere around October, December, that RBI could tinker with the LAF corridor, which is close to about 65 basis points. Now they would like to reinstate it back to the 25 basis points. And last would be the move on policy rates. We believe that RBI could probably consider a first rate hike of 25 basis points in the Q4 of fiscal year 2022. So we are looking at rate hikes, but probably a year away from now. In terms of our thoughts on where we expect the yields and the rupee, I will just take a minute on explaining our outlook on both. On rates, we expect the 10-year GSEC to range between 6 to 6.25. We have to understand that there is a backdrop of excess supply emerging from the extra borrowing that the government has already announced for FY21, and also the higher than expected market borrowings for FY22. Now, given that a major participant will remain, nearly absent, and we've seen that pattern in the last couple of years, that is the foreign portfolio investors, the onus once again will be on RBI to participate and buy bonds in the market to as much as to the extent possible. And this we believe, will continue, as we've seen that in FY21, we believe that it will continue in FY22. And this will also enable an upside cap on the yields. And this is where our range of 6 to 6.25 in terms of view emerges from. In terms of rupee, we are looking at, we have alluded to recovery in growth taking shape. We have alluded to inflation softening to 5%. These inflation dynamics, along with the global economy, where we expect the dollar to indicate some degree of weakness, especially from a fundamentals perspective. In addition to that, from a global perspective, the large amount of liquidity inflow that we have seen this year is likely to continue next year. And we believe that RBI will continue to manage exchange rates like it did this year. In fact, the governor has been extremely vocal about it and has not minced his words when expressing the need to manage exchange rates in a developing economy such as India. In keeping these factors in mind, we believe that RBI will let the rupee appreciate. However, the appreciation in the rupee will be done probably unwillingly in our view. So we are in for some kind of a controlled appreciation in rupee. To just put it in numbers, we are looking at a level of 71.5 by March 22 of USD INR, which is almost 2 to 3% of appreciation in the year. I will just like to leave with two risks that we will be mindful of. Shubda has already alluded to the rise in commodity prices. The other would be the V-shaped recovery in the global economy that is being built into in our forecasts. There could be, some upsetting factor there in terms of how sharp that recovery could be. We have already seen delays as far as the rollout of vaccine in the Euro region is concerned. The second risk could be with respect to what we, what the broad view on dollar is. So market and on the street, almost everybody is biased towards calling for dollar weakness going into 2021. Now, this we look at it as a behavioral risk. That any kind of volatility or uncertainty could upset this herd mentality of a dollar weakness, which could probably impinge on our forecasts as well. So I will leave our thoughts here, and I will probably hand it over back to Mr. Nirendra for.
Yeah, thank you, Dr. M. Subhadra Rao, and also her very able assistant, Yuvika Singhal. Your presentation primarily in the terms of medium and long-term projection, and also the entire market dynamics, regulator response, all that in, and also predicting on the rupee or 10-year bond. All these are highly appreciated, and from the analyst point of view, which you have presented, and quite a lot of, I think, our participants, even on the inflation front, all that their questions already being answered by this presentation. Now I request.
Sir, just 30 seconds. She's not my assistant. She's a very able and a smart economist.
Yeah. I know. She's the one amongst the partner only. So with that, I request Mr. Anant Narayan to present his views. Anant Narayan?
Yeah, thank you, Mr. Narendra, and thank
Yeah.
you, NCube, for the opportunity. Shubda said she's going to run a 100-meter dash. I think it was slightly more than that. But anyway, pleasure to listen to both Anand Sinha Saab as well as Shubda's presentation. I'm not, in the interest of time, I'm not going to repeat a lot of what is common. Very quick points. I agree with both the speakers that the credibility of the numbers in this budget is very, very good. There's one person who's become unemployed after the budget, and that is me, because I used to spend a lot of time writing articles about how much of a fraud is there in the budget numbers. That has become defunct going forward. But it's really good. I think it augurs well for payment of government dues on time. It augurs well for not getting silly tax notices for silly reasons from tax people who are chasing unreasonable targets. And it also augurs well for better analysis by experts once you have the right numbers out there. The second thing I like about the budget, and I'm surprised I'm saying so many nice things about the budget, but the second thing I really like about the budget, it gives a good shot towards creating jobs and output. And I will try and make this point about how critical it is that domestic output and jobs has to be kept up going forward. And that's, I think, the biggest risk besides execution going forward. What does it do? It specifically moves money from revenue expenditures to capital expenditures, 26% higher, as Mr. Anand Sinha said. It also tries to do a lot on the financial services sector. And I'll try and spend some time on that and expand on that, going beyond what Mr. Anand Sinha said. The talk of a bad bank, the talk of a DFI, very, very critical, I think, for getting jobs and output back in the system. And the third thing, as everybody agreed, no new taxes. So again, that's very, very useful at a time like this. Now let's go beyond the budget and what do we see going forward? First things first, look, the GDP numbers for FY21, the current fiscal years, will probably come better than people expect. So minus 7.7 is what NSO said. A lot of analysts are already calling for it to be less than that, less contraction than that. I would caution against celebration here, though. The NSO numbers do not take into account the actual situation as far as the micro, small, and medium enterprises are concerned. There is a lot of pain in the ecosystem. We are going by value added by the larger companies and the listed companies, etc. That is not reflective of all of India. So the actual contraction this year is probably in double digits. It's probably 11 to 12% contraction if you take into account what's happening on the MSME sector. Now that's the bad news. The other bad news is, as Mr. Sinha said, even before COVID hit us, there were several sectors which are going through serious chronic stresses. The financial services, power, real estate, telecom, airline shipping, MSMEs, they were going through a lot of hell. And COVID-19, and the reason I mentioned double-digit real contraction is it only adds to the size of this problem and overhang. So while we celebrate, the fact that the crisis has been taken in the right way by the government, there's a lot of hard work to be done, and we cannot afford to be complacent going forward on this. So that's the other tough part that we have to contend with. What are the good news? The good news beyond all this, there is a recovery underway. It's a K-shaped recovery, lots of alphabets being used, but I do agree it's a K-shaped recovery. The rural sector seems to be doing well. The urban middle class, the white collar workers seem to be doing well. There's a lot of pain, though, in the bottom of the K amongst the micro, small, and medium enterprises and the urban poor. It's not a good sign there at all. Nevertheless, the top part of the K is running up some amount of consumption. The 1.2 lakh crores of GST collections we saw in January is fantastic. It's reflective of a bounce up in consumption, even before contact services take hold, which means that there is some legs to this consumption. I don't think it's just a one-off. I think it will continue. Second huge positive, which both speakers spoke of, COVID-19 we have avoided the second wave, and I hope and pray, fingers crossed. Let's pray to every god we know. It stays that way, and that's a huge positive, and economic recovery, therefore, is underway as well. But huge challenges going forward. Now, why do I think jobs and output is very critical? And I'm sure we'll all agree, but why is it nevertheless very critical? I want to take a parallel to what happened between 2008 and 2013. It's not a very popular parallel, and there'll be lots of reasons why we shouldn't draw the parallel, but nevertheless, I want to draw the parallel. After the global financial crisis, which, as Mr. Sinha said, did not impact us so much directly, it was an indirect impact, unlike COVID-19. We actually did a lot of good things, right? We pushed up the fiscal lever. We allowed a lot of spending to come through. At that point of time, banks were lending a lot as well. So credit growth was in 25 to 30% range. And the economy recovered pretty fast. Okay, both markets as well as the economy recovered pretty fast. Between 2009 and 2013, the fiscal years, we actually saw consumption, investment, and government spending grow over 15% per annum. It was really robust growth in nominal terms. Yet we landed up in trouble. And what was the trouble? The trouble was not on the demand side. The trouble was we were not creating enough domestic output. Our demand was either going into things like proteins, as Dr. Gokarn, the late Dr. Gokarn used to write in his papers. It was going into more of vegetables, more of eggs, more of milk, etc., and therefore causing food inflation, where there was supply constraint, domestic supply constraints, or it was going into things like electronics, gold, plastics, fertilizers, chemicals, white goods, all of which have a large import component. Even today, a lot of the intermediates required for all of this have a large import component. So if you're not creating enough domestic output and therefore not creating enough jobs, for all this 15% growth we saw in consumption, investment, and government spending, our net imports was growing at almost 30% per annum through that period. India's fundamental problem has been we've not been able to keep up domestic production to domestic demand. Yes, we don't produce the things we need. We don't even produce surplus of that and in export terms. So that led to a twin deficit crisis, that led to inflation, that led to financial instability. And then when the taper tantrum happened, and make no mistake, there will be a taper tantrum equivalent in the globe, very, very likely in a few years from now. Okay, we don't know when, impossible to time it, but we have to be prepared for it. So when 2013 taper tantrum happened, all hell broke loose. Why am I drawing this parallel? There's a lot of focus now on consumption resuming. There's a lot of focus now on government spending remaining pretty strong, which is good, required at this point in time, no questions asked. There is an investment, by the way, investment is missing. There's also a lot of money supply growth, as we saw in that period. There is money in the system. Look at currency in circulation up by 22%. Look at Jan Dhan Yojana accounts balances up by 21% year on year. Look at M1 up by 20% year on year. There is money in the system, and it is stoking both asset demand, which is reflected in the stock markets, as well as in consumption demand. Okay. Now, if we don't follow it up with domestic output and jobs, we're going to be in trouble. Okay. With the high amount of public debt we are carrying on our books, 90% of GDP, we're going to be in trouble. Good news, the government is focused on jobs and output. Atmanirbhar Bharat is all about that. It is about domestic output, domestic jobs, right? So you've had labor reforms, you've had tax reforms, you've had PLIs, the production-linked incentives. Clearly, all steps to try and ensure that we produce more and create more jobs. But it's not going to be easy. This is not 3 laws that you change and you create jobs and output. We've had chronic issues in creating domestic output and jobs. Why is it that 44% of our workforce is still engaged in agriculture, which produces just 15% of our GDP? Why is it that only 17% of our GDP, as measured by the NSO, is produced by women? These are terrible statistics, and we can go on and on. So the problem in creating domestic output and jobs is just immense. I can tell you several stories of SMEs who would rather trade and import stuff from China or Taiwan and sell it here rather than produce it themselves out here. There are too many such stories. I don't want to go into them right now. We are making the changes, but it's a long, long road ahead. 2 things required, I think, for making this shift towards jobs and output, which is, frankly, China didn't become China because of a fantastic monetary policy framework or a fiscal policy framework. I would challenge people to tell me what is the monetary policy framework of China. I can tell you that even economists will struggle to answer that. They got 2 things right, jobs and output. Okay, then they could fudge everything else. Their numbers are worse than ours. They could fudge everything else, right? So what does it take to create jobs and output? First, financial services ecosystem. Okay, we are talking about, we'll do this, we will do that, we will get some capital inside. Hey, boss, it's not enough to get the financial services ecosystem to survive. That is a very low bar. It will survive. India, everything will survive. Nothing will happen. Okay, we need the financial services ecosystem to run a marathon. It has to fund growth in this country. Our debt, our credit to GDP, bank credit to GDP is barely 50%, 55% if you stretch things. Okay, China's credit to GDP is over 200%. They could create that much amount of credit because they've had creating jobs and output. But our banks are not even in a position to create that kind of credit right now. And that is important. And which is why this thing like a bad bank, things like a DFI are so critical. Now, as Mr. Sinha said, the devil is in the details. We don't know what's going to come out in the bad bank. There are several ways in which you can make bad bank a terrible idea. Okay, IDBI created a bad bank many years ago. It was a complete waste of time. Okay, we shouldn't go down that path. Now, I'm going to spend 2 minutes on this bad bank part. It is not just the bad bank alone or the DFI alone. You require, in Dr. Arvind Subramaniam spoke of 4 R's, right? Which is recognition, resolution, recapitalization, and reforms. We have still not done full recognition, okay? Because of COVID-19, NBFC's recognition is still not done. If you go just by the FSR, the Financial Stability Report of the RBI, the actual level of non-performing assets as a percentage of GDP, not of advances, is between 13.5% to 15% of GDP if you include the written off amounts already, which is about 8.5 lakh crores. That's a tremendous number. It's like 27% of advances if you include the written off amounts as well. No bank, the IBC is good, the Insolvency Bankruptcy Code is good, but no bankruptcy code in the world can handle this size of overhang of non-performing assets. We need a one-time solution to clean this up. Now, bad bank, we will wait for the details. There are examples in the world where this has worked very well. Malaysian example I personally like, where actually the government was involved. I think the government ought to be involved. Mr. Sinha, I know he said, government will create the same kind of problems which are there in PSUs. But the reason I think it requires to be involved is a lot of the other NPAs which are there in the system, power, telecom, infrastructure, airline and shipping, and so on and so forth. These require government intervention. So it's best that the NPAs come to a body which can handle the recovery as well, including by passing legislation, etc. But just doing a bad bank, not enough. Do something, first of all. Don't just, kick the can down the road. Do something. Anything is fine. You also have to do reforms. And on reforms, I'll add to what Mr. Sinha said about PJ committee reforms. The first thing we've got to do is get our babus and netas out of banking. Okay. Our public sector bankers are fantastic. As a foreign banker, I can tell you, our public sector bankers are fantastic. I've dealt with them. They're thorough professionals, but they are operating with their hands tied behind their back. They don't have a level playing field. They are under Nationalization Act. They're not under Companies Act, which means Mr. Dinesh Khara gets 30 lakh rupees of total compensation for the full year, which makes no sense whatsoever, right? For handling a 40 lakh crore balance sheet. They're constantly worried about the 3 C's, the CVG, CAC, the CACAG, the CVC, and the CBI. Private sector banks are not worried about all that. So you've got to give them a level playing field. Get babus and netas out of banking. Okay, privatization of 2 banks is not enough. We've got to do, get the public sector banks under Companies Act. Maybe move all the ownership of public sector banks into a separate bank investment committee, which was what the PJNI committees recommended. In Singapore, DBS Bank is owned majorly by the government of Singapore. But the government of Singapore does not get involved in day-to-day banking. It does not say telephone banking. It does not do, Shamiana banking. It does not do Mudra banking. It allows the public sector banks to do what has to be done. Okay, we need the same in India. We've got excellent bankers. Give them the professional autonomy to do their jobs. That's huge reform required. By the way, people mix this up with governance reforms. Governance reforms are required everywhere. Every single bank, whether it's private sector, public sector, foreign bank, requires governance reforms. That a separate set of work is happening, whether it is board reform, whether it is auditor reform, whether it is regulatory scrutiny reform. You need governance reform separately. You need public sector bank reform so that you free them completely separately. So that's one big part, clean up the financial services ecosystem. That will also help you clean up things like the power sector, real estate, telecom, MSMEs, etc., separately. Okay, and bad bank, I think, is an important part of that. Very quickly on jobs and output, that's just the financing of the financing of growth. The actual implementation of jobs and output. Again, great steps in terms of tax cuts, in terms of labor reforms, in terms of PLI. I think PLI can be a game changer, and I hope it works out. It'll take time. It'll take 1 or 2 years, but I'm hoping it works out. But it's not enough. Okay. I've been a sinful, foreign banker, taking clients to places like China to look at investment opportunities there. When you go to a province in China, the mayor out there will roll out the red carpet. He will tell you, here is the land, here is a single window, all your forms are filled up, just sign the dotted line, bring the money in, construction permits, everything is here. Set up the factory, employ 100 people, create output, 15-year tax holiday, just go. And you have 50 mayors in 50 provinces who are rolling out the red carpet, telling you to please come to their province. Okay, you cannot have a centralized Beijing Prime Minister's office run jobs and output across the country. It has to be a complete decentralized model where the entire government ecosystem is actually furthering the cause of jobs and output. It can happen. India, there is no problem in India which cannot be resolved, but a lot of hard work is required going forward. So I'll stop on this note, Mr. Narendra. I think excellent budget. For the first time in many years, I'm actually praising a budget. It does all the right things, but a lot of hard work to be done. It will be a mistake to understate the stresses we are under, especially certain sectors of our economy. They're still under a lot of stresses. There are huge macroeconomic risks. There is a possibility of a repeat of 2008, 2013 if we are not careful, if we do not create jobs and output. Good news, we are taking the right steps in that direction. Financial sector reform, extremely critical so that credit is created for creation of jobs and output. On the real sector, and without the real economy, none of our growth is going to happen. On the real sector, good steps are happening, but the road ahead is going to be the next 10 years. It's not the next 1 month or 2 months, it's the next 10 years. A lot of steps at multiple levels have to be taken before that comes about. I'll stop there, Mr. Narendra.
Yeah, I'm really appreciate you for Anant Narayan to be on a very frank, as well as his focus always has been job and output, and he's also the fact that he appreciated the public sector bank inner potential and inner skill capabilities and all that. That is also, and what type of autonomy and level playing field is required, and the overall, and he has given a very clear cut his opinion for the Indian economy to come to the higher level of growth and jobs and employment. Can I now request Ms. Deepti Deshpande quickly give her comments?
Sure. Good evening, everybody. And thank you to NQ Collaborations and the other partners for having me on the panel. Also, good evening to my fellow panel members. I too would like to begin by speaking about essentially the backdrop of this budget, which was very, very different. A once in a century sort of an event, which saw a steepest ever decline in GDP. And again, in a scenario where the Indian economy was already on a weak footing. So naturally, the curiosity in the system was extremely high as to what the budget would have to offer for FY 2022. In my opinion, two choices lay before the budget. One was essentially how it would support the nascent stage of recovery, given that last year was more so about damage control largely in nature. And secondly, what would the budget essentially do in order to iron out some of the pandemic induced anomalies that got created in the last year, that is in 2020. Overall, if you look at the budget, I feel that the budget did touch upon both of these points. However, the way they touched it was quite different from what many expected. So firstly, I think the budget focuses on growth and not just short-term growth. What has come in a very good light is the fact that there is medium term that is in sight. There is a conscious tilt towards focusing on capex, despite the fact that they were working on a very tight fiscal position. So this provides optimism for growth and also creates a platform for medium-term growth. Of course, given all the shortcomings that was spoken about by my fellow panel members. But what I'd also like to say is that because the focus is on an investment push growth rather than a consumption-led growth, growth will take time to come by, only when the productive capacities of the economy have completely been enhanced. So in the meanwhile, I think recovery will be to a large extent based on some of the, if I may say, inherent forces of the economy, which are currently not very strong in nature. So given this backdrop, CRISIL expects GDP to grow by about 11% in fiscal 2022. And largely, I'd say this is going to be more of an optical recovery of sorts if you look at the overall fiscal per se. Because if you look at the overall GDP level in real terms, it's just about 2.5% below above fiscal 2020. And compared to the trend, it's about 10% lower. The second part that I was alluding to a while back was what exactly the budget has done in terms of correcting some of the pandemic induced dichotomies. And if I may, there are three to that respect. Number one is if you look at the sectoral level GDP, manufacturing is seeing faster recovery compared to services, especially the contact based services like trade, hotels, transport, communication, etc. Second is, as Mr. Anand also spoke about, small firms have gotten terribly hit by this pandemic, even though there was some sort of a policy support that did come in. Because essentially, smaller firms have relatively weaker bargaining power. The access to formal channels of credit is relatively low. And they could not, for instance, take course of work from home and other opportunities. The third aspect that I would also like to talk about is that policy support, which came right after the pandemic, essentially got more focused towards the rural segments of the economy. One was because they were perceived to be more vulnerable in nature. And second, maybe because the channels to reach out to the rural poor were far better than the channels available to reach out to the urban poor, who are also to a larger extent hit by the pandemic, if not more. So I think given these three dichotomies, if you look at the budget, we did not see any specific budget announcements that came their way. So one can broadly go to assume that it is growth that is expected to take care of or iron out some of these scars or anomalies in the economy per se. However, I think the point to also note is that if you look at these segments, for example, the one that I mentioned, the contact-based services segment of trade, hotels, transport, this is the biggest employer after agriculture. Similar is the case with MSMEs and also the urban poor who contribute significantly to some of these services. So given the fact that these did not get significant income or job support measures or did not get support from some of these measures in the budget right before that, I think these are the segments which essentially can, over in the near term, constrain a very sharp pickup in growth. And therefore, I think that is something that we'd like to keep in mind when we are looking at a growth forecast of fiscal 2022 per se. Now, having said that, the budget does score well on many fronts, and I won't really like to repeat the points that have already been mentioned. Transparency is certainly one. Normalization of expenditures is also very key. I think there was a conscious choice to reduce fiscal deficit for fiscal 2022 by focusing on capex and reducing revenue expenditures. So that is also something that is seen in positive light. When we speak about transparency, another angle that I would like to talk about is if we look at capex, one is that the government provides for capex from its own budget, whereas the second is the role of public sector enterprises coming in through what is now called as the IEBR. And if you look at it, there is now a gradual shift towards taking most of the capex on board. That is, the government is budgeting for it through its own finances rather than nudging public sector enterprises to essentially go out in the market and borrow. The third important point that I would like to also talk about is that choosing to, for the time being, choosing to not focus on the FRBM target of 3% of fiscal deficit to a large extent creates additional fiscal room for the government over the medium term, that is until FY 25-26 that they've stated. And this is absolutely critical to look at if, for instance, we assume that the government continues on its intent to go the capex way to push growth. I think putting this together certainly bodes quite well for the medium term. 2-3 other points which I feel we should look at, which are outside the budget, but are also getting some sort of a support when we want to look beyond FY22, is number one, it's not just centers expenditure on capex that matters, but we are also now quite aware that state government's spending on capital expenditure is more than half of total government spending on that area. So if there is some relaxation of FRBM targets for the center, it would perhaps also mean that states get some part of that relaxation too. Of course, we would need to wait and watch on how that goes around. But overall, I'd like to say there's more fiscal room available for the next 5 years than we had for the last 5 years, that is pre-COVID. The second point, when you look at the medium term, is essentially the fact that if you look at global growth, on average for the next 5 years, it's expected to be slightly higher than what we did in the past five. However, I think a caveat there is over time, if we go to see the trade intensity of global growth has come down. So higher global growth does not directly imply that it's going to significantly help boost exports. However, I think the opportunity is certainly available to perhaps some sectors and in certain economies. The third factor, when I would like to talk about medium-term growth, is the fact that there is evidence which shows that in the last couple of years, 3 to 4 years, we have larger corporates who have deleveraging and lower interest costs have helped them. So perhaps going forward, these large corporates are probably going to be in a better position to invest, provided there is appetite for such kind of investments and provided they see certainty of demand and continuous improvement in business environment that comes by. Finally, I think the fourth and final factor, which is also important to look at, is that financial conditions are easy and likely to be overall easy, at least for at the beginning of the next 5-year period, which wasn't essentially the case in 2014 and 15. Plus, if you look at banks, although the bank cleanup process is underway, broadly, they are in a better position to fund growth for the next 5 years than they were, again, say 5 years back. So overall, I think all of these factors are equally important when you look at the budget and in terms of a backdrop to the budget. Thank you.
What excellent presentation, Dipti, that particularly that what are the areas budget could not take take a note of that, particularly the transport or supply chain or the airlines or such a, or maybe hospitality, all of them who have been affected. There were no much mention of any specific measures, and similarly, the not much having fiscal space, but at the same time, through the expenditure, particularly on capex, and creating the growth and not giving much fiscal incentives. So I think, and also very critically from the CRISIL experience you have analyzed, I think all our participants are well benefited. Can I now request Mr. R. Kannan from the corporate angle, what are his views and what is the implementation as such? What is the what you call realization thereof, and how this is, and similarly the private investment is likely to come on that point? Kannan.
Yeah. Good evening, Dr. Sinha. I would like to thank Dr. Narendra for giving me this opportunity. This budget actually, it went beyond the expectations of all the corporates in terms of the schemes being announced by the government. And in fact, there are several, in fact, on the side of finance, it was all well elaborated by speakers before. And if you see, they are talking about six pillars, considering that we are in this situation of a pandemic, which rightly so, they have given a very good allocation for health part of it. On the physical side, if you see the roads, I was just looking into sector-wise allocation. If you see sector-wise allocation, housing ministry, they got 54,581 crores. Health this year they are given 73,932 crores. Education is 93,224 crores. Railways is 1,10,055 crores. Transportation is 1,18,000 crores. Agriculture has got the maximum, 1,31,531 crores. And rural development, 1,33,390 crores. Housing, a home ministry has got 166. So if we see that there is an emphasis on physical infrastructure, and one good thing is that they talked about infra pipeline earlier. They extended that up to 7,500 projects. As of now, out of 100 lakh crores identified earlier, 1 lakh crore of project has been already completed. And second part is relating to this Atmanirbhar Bharat. Atmanirbhar Bharat, they identified 13 sectors where the allocation for this year has been given. I will call it as Make in India 2.0. Because 2014, we set a target. That time, manufacturing to GDP was 16%, and they wanted to take it to 25%. So they identified 25 sectors, but somehow by 2020, the manufacturing still contributed only 16.7%. But now what has happened, they identified these 13 sectors, which are already, we are globally competitive in the world, like automobile or pharma or textiles. India is globally competitive in 10 industries, and some of the sectors which they covered in Atmanirbhar Bharat are already we are competitive and will be more competitive. So what you will see here, there's a lot of liquidity in the system worldwide. More than $20 trillion in the world are carrying a negative interest. So what has happened? Some of these large investment institutions like pension funds, long-term funds, in fact, they decided last year that they cannot continue to invest only in traditional instruments. So they have to start looking at new instruments. That's worldwide. Canadian pension fund, American pension fund, Australian pension funds. So all these people are with a lot of money and they are looking for assets which will give them yield. So that is how India has been one of the very attractive places. This is from a FII point of view. From FDI point of view, already we know that in the first 6 months, 9 months, FDI is much higher than last year. After this Atmanirbhar Bharat, I can tell you at least 3-4 large Chinese companies, already they are given big orders for manufacturing to Indian companies. One good example is Realme. Realme, they are manufacturing, they are one of the leaders in manufacture of TVs. So 38-inch, 43-inch, 55-inch TVs, they are given contract manufacturing to 4 Indian companies. So what we will see many of these companies from US, Europe, China, and Asia. What they will do, they will come and try to, either they'll set up a manufacturing unit or they will tie up with the Indian company which is already manufacturing, ask them to expand. So this is one of the good areas where we will see even employment generation. And the other point which I wanted to bring to notice was, last 4 years I was always talking about we have a lot of hidden strengths in the public sector. If you ask me, even a lot of strengths in the public sector banks, in the sense that they own a lot of assets all across India. So they they have a lot of land. So they decided, government has decided that they will look at these physical assets and how to go and capitalize them. So for example, if they want to develop a port sector, they are saying that they will tie up with private sector to operate the existing ports. From the revenue they get, they will take the funds for development of port sector. That is what they are planning. Similarly, road sector, even though there is a big budget, now this concept of REIT and InvIT, even though it was discussed for last 5-6 years, we saw only 2 or 3 REITs and InvITs coming in India. And of course, last year we saw few deals in private sector also. Now, all these assets, they are going to do it on a REIT, InvIT form, leasing the assets, selling them, all that they are going to do. So that is going to be another area where it is going to be a non-traditional source of funding. I was just looking at some of the numbers which they are given in the budget. If you see the numbers, GDP in 2020 was 203.5 lakhs. 2021, the projection is it will be 194 lakhs, only 10 lakh crores less than previous year. But in 2022, we expect it will be 222 lakh crores. That is about 28 lakh crores. They are expecting that 14% what everybody is talking about. And tax revenue, actually, we saw a very, very small deficit and shortfall. Last year was 13.56 lakhs. Despite the pandemic, the government is projecting a collection of 13.44 lakhs. But most of that has come from collection from this petrol and diesel. Yeah, that is what is filled up. But next year, they are projecting a very big increase. I think it has a part of petrol and diesel also. They are projecting an increase of 4.44 lakh crores, which will be 17.88 lakh crores. Non-tax revenue, actually, they didn't do much this year. Last year was 3.27 lakh crores. This year, 2.1 lakh. And next year, they are not projecting a big number. See the receipts. Even though the economy was not doing well, last year, total receipts of government was 26.86 lakh crores. But this year, government received 34.5 lakh crores. Next year, they assumed receipts will be same. They are not assuming big increase in receipts, because this year they had a lot of extraordinary expenses for which they have to collect lot of other funds. We have funds coming from ADB. We have funds coming from World Bank. We had funds coming from AIB. We had funds coming from New Development Bank. All these are supported. So capital account last year was 3.35 lakh crores. This year 4.39. Next year, that is one projection, 5.54 lakh crores. There in the component, there is a 50,000 crore for central government that we are not aware, which means the government itself is, one of the speakers mentioned, the government itself is planning to spend. So they have a cushion of 50,000 crores, which they allocated as a part of a capital budget, capital account, which government will decide where they will invest. Revenue deficit this year, we are discussing about fiscal deficit and FRBM targets. Certainly, I can tell you this is much lower than what our initial expectations were. We were thinking that the government have to borrow maybe 20 lakh crores, 25 lakh crores. Actually, from the market, they borrowed only 12 lakh crores last year, not 18 or 20. So they were able to manage that. But now they also they gave a concession to state governments to extend their ratio of borrowing of a state GDP. This year also they given the allowances to them. And coming to some of the other areas, if you see, debt to GDP, of course, IMF calculation is 80%. Now that they are showing a very big increase in national income this year, they are showing debt to GDP ratio will come down from 62.2% as of 2021. I don't know, maybe economists will be able to tell us where is the difference of 62.2%, and that is likely to come down to 61% next year. And some of the expenses, if you see, subsidies, last year was 2.6 lakh crores. This year, they spent 4 lakh crores more, 6.5 lakh crores, but they are planning to cut some 2-3 schemes. Some Prime Minister, some Yojana is there. Then they are planning to cut food subsidy, which is a big subsidy. They are giving free food to 80 crore people for many months. So that subsidy will come down from 6.5 lakh crores to 3.7 lakh crores, savings of 2.8 lakh crores. Pension, I am surprised. Pension last year was 1.8 lakh crore, this year 2.0. But next year they're planning to reduce pension. I don't know, pensioners are going to be more, and maybe they are thinking of capping the increase in pension for employees. But yesterday there was I think government announced some scheme whereby pension which was capped at 46,000 was increased to 1,25,000. But there is an assumption that they are going to reduce some pension. I don't know where they are going to cut. Defense, 3.2 lakh crores last year, 3.4 this year. They are kept at the same level, 3.5 lakh crores, a little increase. And debt receipt, we are only talking about borrowing, but you have to see debt receipts. Debt means you are borrowing from other sources also, like World Bank, Asian Development Bank, Asian Infrastructure Investment Bank, New Development Bank. All these banks, if you look at debt receipts, their total receipts, it is not 12 lakh crores. Last year, it was 9.3 lakh crores. This year, actually, it is 18.5 lakh crores. 6.5 lakh crores more than the borrowing the government has done. But next year, they are planning to reduce it to 15.1 lakh crore. The assumption behind is that, again, India is the largest borrower from any of the development financial institutions who have exposure in India, whether it is World Bank, Asian Development Bank, I think even New Development Bank, Asia Infrastructure Bank, IFC. You look at from all these places, we have the largest borrowing. We are the largest borrowing country. So they are all looking at, and one more thing, Canadian pension funds alone have invested more than $60 billion in India. After some of these write-ups I have returned, I saw our government institutions started taking money from institutions like JICA of Japan, JBAC, and other institutions, maybe KFW. So we are able to attract more and more sources of funds into India. Mainly, if you ask me, that Atmanirbhar Bharat is going to be a center around which we will be able to attract a lot of capital for growth. And overall, this budget is a very good budget. Thank you.
Thank you, Kannan, for a very critical analysis on the various budget figure. For the information, everybody would have seen 20% of the money goes to interest payment, and around 16% to state share, 10% to that finance commission and other transfers, 14% to central sector schemes, 10% to other expenditure. Your that pension 5%, and centrally sponsored scheme 9%, defense only 8%, and 8% subsidy. So that is where the allocation of money which comes in and which goes out. And as you rightly said, with the even external debt around, I think other day our Anurag Thakur, Minister for State Finance, mentioned that of course that time we had a forex reserves of $590 billion, and so whereas I think it must be around $580 billion external debt. So we are in surplus. So India has more than, I think, 18 months of now import cover. So this is primarily coming to large FDI. Even now in this period also, we would have received 32 or even more than that US dollar what you call FDI, and around 8 to 9 billion US dollar of portfolio investment. Anyway, I will come back later with the. Now we have to hear from Sunil Goyal. What are the taxation measures? What are the various impact on other SSCs? And what is the critical thing in the budget in terms of some of the indirect taxes and all? So can I have Mr. Sunil Goyal ji? Yeah. आपका म्यूट करिए सर, अनम्यूट. Yeah. Yeah. Clear.
Thank you, Narendra sir, and good evening to all the participants and to all my fellow panel speakers. It's indeed a great opportunity to speak to you. In fact, on behalf of a group of medium-sized entrepreneurs, about 1.5 years back in August 2019, I had an opportunity to meet the Honorable Finance Minister to represent the industry and the business people's view as to what kind of hardship they were going through. And among various other factors, the one major concern was that the entrepreneurship was getting killed. The new generation was not at all wanted to get into the business. Business world has become the sort of bad word, and the criminal act was applicable to any fault or default willingly, knowingly or unknowingly. And in that backdrop, when we met FM, she patiently listened and kept our memorandum, which contained most of the points which my other fellow speakers had spoken about, the bad state of the economy a few years back. And now when we look at today, what kind of this budget is, I think after 1991, 30 years after the new India was born, the new budget has been presented by the FM. And see what a budget contains. A budget is amalgam of intent. It contains the policy and framework and the transparency. And if you look at this year's budget, I think it fulfills all these parameters, and all these pillars are very well defined. And we have been seeing that when we critically analyze the budget, sometimes we say it's a bad budget, and bad budget is why it does not even address the current year's. It doesn't address the current year's the current problems. A good budget we term is that the budget which addresses the current need of the time, and an excellent budget is which not only addresses the current environment, but also it takes care of the future sustainable growth. And I think this piece of budget gives us this conviction to say that this piece of budget entails a sustained growth in following years. When I speak to my clients and when I see my personal experience of dealing with them, post 2012-13, I don't think major capex had taken place. And the people are just waiting and watching the various happenings in the economy. But now I think the confidence is coming back, and the most entrepreneurs, they are talking about the expansion. And this expansion is very much needed. The capacity which got added until 2012-13 is not now sufficient, because the part of that has also become obsolete. And therefore, with the economy getting revived, the demand is increasing, the disposable money is increasing, the government spending and quality spending is increasing. I think with that, the business spirit, the animal spirit is coming back. And this I'm talking about on a very happy note. And I think we all should be happy to note that this is the new India which is taking the place. While we are talking about the good things which are happening in our economy, and the budget provides that impetus, I'm not getting into the data, and because the former panel speakers have spoken about a lot of data and other things, but I'm talking about on a broad basis as to how this is going to impact us positively. So the job creation was the major problem. I think with the more infra spending and the demand getting created, the job creation would happen. And the quality spent, what the spending was 15-20 years back, the same amount, if it is being spent today, it really gets into the right direction, and it channelize more number of jobs. Somebody mentioned that the quality infra spent, it has a 7-time money multiplier in terms of the job, and that's true. So if you look at the kind of spend which is going to happen, it would certainly create more jobs and provide the opportunity to work to the youth. Not only that, with the revival of the animal spirit, the Indian youth, where the entrepreneurship is there in the blood. I think this youth, because the kind of youth we are having now, every year the number of graduates getting added every year, it is difficult for any government to provide jobs to that class. And therefore, for our kind of economy, I think the self-entrepreneurship is something which is getting the momentum, and more people, the young people, are trying to get into entrepreneurship. And that would solve the problem alongside while the service job are getting created. The second thing which this government is, through this budget, is trying to address is the harnessing the human capital through the wellness, because in any society, when you don't have the right kind of human capital, which is fit and fine, you can't really grow well. And if you look at the a large number of people in our country, they don't have access to the right medical treatment or even the nutrition, and therefore they don't have the right kind of health scenario. With a lot of spending on the health and addressing this issue, this sector, I think we are going to benefit with that. And the quality spend multiplied by the right human capital, I think we are in the growth trajectory which we were waiting for. The business confidence index, with all these things are increasing, and believe me, after the budget, I've been getting several calls from my clients that, now they want to either take over some companies or they want to expand capacities, where from they get the funding, and, how do they channelize their, spare funds which they have kept. And I think that's happening for good. And we all must hope that our economy is getting revived. And of course, we have a lot of challenges. We don't have this year's legacy. We have a legacy of many years. And Mr. Anand Narayan spoke about good and bad, many things. But I think currently this budget, we are limiting our discussion to this budget. And I think this budget provide that kind of impetus. And my area of address was also the partly capital market. I think the capital market, we never had this kind of expectation. While we were listening to the FM during the budget speech, after she finished our budget, we could not believe that she has not brought any fresh taxation, or she has not done something which we were very much expecting. And that was on a very happy note that nothing new happened in terms of taxation. And the LIC IPO, the FDI, the governance issues, REITs, InvITs, and the bond market development. I think these are the good factors which have really given growth momentum to the capital market, and that will help raising not only the capital raising to the private sector, but also the government would be able to achieve its target of disinvestment. On the some point of caution, which I think we all have talked about, but just to summarize 2 or 3 points. I think the tax to GDP ratio could be the area of concern. We are as low as 10%. We are among the 142 from the down list at 142 numbers in terms of tax to GDP. But that's rightly so, because our tax paying population is hardly 3 crores, and out of that's not even 2%. So unless that number increases, the tax to GDP ratio would not increase. The second is inflation, which we have talked about, but I think with the farm sector reforms, the inflation can be checked. With the augmentation in the manufacturing, adding to the manufacturing capacities, that could be taken care. I think inequality in the income distribution among the rich and the poor, that could be the area where I think government has to work very seriously on that and ensure that the masses of our public, they get the right due after 70 years of our independence, and they have a reasonable livelihood with them. I think the implementation of what the FM had spoken about, that remains critical. And once that is done, I think we would have a very Atmanirbhar Bharat, which we are all talking about. We will be proud of our country, and we all should look for the good times. And let's contribute what best we can do in that momentum, that spirit of our government. Thank you very much.
Thank you, Sunil Goyalji, that you are really focused on the human capital aspect and inclusive growth, as well as the our young generation and the millennium momentum, and how they can get the self-employment. Very nicely also you given what are the risks to that in terms of tax to GDP ratio, and during the COVID, particularly the divide between the rural and urban, and those who are haves and have-nots, the rich becoming richer, and all that aspect, the equality in terms of that is the, and overall the budget is a growth intensive budget. Thank you very much. And we had quite a lot of questions from the audience, and I find that most of them have been replied. And of course, on the large NPA and other things, one thing to be seen that the banking industry has made a large provisions. Some of them are in overall, it is 74% provision. And even in the December, I think quite a lot of provisions have been made. And the legacy accounts are all have been 100% or covered. Now that with the IBC and other things, the recovery will be the key, and with the establishment of stressed bank and all. So the incrementally, other than the Supreme Court, what you call keeping the standstill, which may be lifted, and a few particularly smaller firms or MSME which are affected, that NPA per se incrementally looks lower. So I think that part which questions were coming, we can have a particular discussion on the banking and NBFC in the later. And overall, the merger also leading to efficiency, and the size also matters in the current scenario. And as rightly pointed by Anant Narayan and all, the credit to GDP is very, very low. So we need a global size banks. And in that respect, the privatization of a few banks to begin with, and with the more autonomy, is a welcome sign. So that was another question which has come. So for the lack of time, even though I know panelists have quite a lot of further information, one issue which I have also normally, that MSME, which Anant Narayan always talks, that this budget I think given around 15,000 odd crores. But overall MSME, in spite of all the measures, particularly informal sector, are affected. So some of the bigger firms or larger firms who have money, they should invest in the MSME and give a support to them with as equity. And with that, our MSME really, like, we have to increase our export from the MSME from 50% to 60%, their GDP from 40% to 50%. So we need the MSME, which are the greater employment opportunities. And in spite of the emergency credit guarantee scheme, quite a lot of the MSMEs are in the formal sector. So that scheme could not be fully availed by them. So how are we to help them? So in that respect also, that MSME is the one area. And even though we are expecting recovery, like, today government has freed the tariff for the airlines. Now the airline will have a full capacity and full tariff. So they will come back, and the whatever losses per day they incurred, they with the enhanced utilization, they will be able to cover. With this, I think there are, of course, the borrowings also one of the concern which have been coming in the panelist. But the government now, instead of putting a certain additional taxes or increasing the rate of taxes, they found that as a panelist have mentioned, this is the right time to first push our fiscal expenditure, even though at the cost of higher fiscal deficit, and the market has the appetite. And one important thing is the Reserve Bank has now given direct access to the retail investors in the gilt. This is a major change, and with that, more participation, and the government, RBI, will continue to, as panelists have mentioned, will observe and see that with the, recently also the 10-year yield moved up, and now they could come back to 6%. So RBI not only manages the borrowing smoothly, RBI also manages the foreign inflow, and without affecting the rupee dollar rate, so that the exporters are reasonably benefited, not at the cost of importers also. These are all very important, and RBI has got more and more conventional and unconventional measures, and at the appropriate time they will take. But all participants, and the banks particularly, and all of them will have to be take extra care for incremental capital and additional support internally to withstand whatever the shock, and be ready for growth. Panelist ji, I may not further ask question due to the time. Now, can I request our district governor from Lions, Dr. Geet Prakash A, to give a few minutes, 5 minutes, his presidential address.
Okay.
Yeah.
Good evening, sir. Good evening, everybody. Now, today, being the district governor for the district 317D, the Lions Club International, one of the largest service organization in the world, I'm extremely happy to have a panel discussion on the union budget 2021-22. Now today, this was possible only because of our enthusiastic and most resourceful advisor, Dr. M. Narendra sir. He has made it possible, and we are all grateful to Dr. M. Narendra. Especially, it is truly an amazing experience to witness the magnanimous panelists in a discussion on union budget, and especially our panelists Anand Sinha sir, Dr. Shubhada Rao, Anant Narayan, Kannan, and Deep Deshpande, Sunil Goyal. They have done the critical analysis of the budget, and definitely an organization like Lions, it has come forward to discuss and exchange our views through our youth exchange and youth camp coordinator, Lion Vijay Vishnu, who is instrumental in arranging this panel discussion. I think all the Lions fraternity are happy with the specialists talking and discussing on the budget, and definitely, as all said, it is an excellent budget which shows a sustained growth in the future years. I think I compliment each and everyone for the excellent participation, and thank you one and all.
Sir, we are always inspired by your leadership, and as you rightly said, Mr. Lion Vijay Maya under the youth movement has been doing quite a lot of program, and it is for the benefit of Lion members and all our bankers, analysts, and professionals, and all of them. This talk by very reputed and very esteemed panelists, very critical, has been very useful. I also take this opportunity that one of our knowledge partner think tank webinars and knowledge series, they have a particular what you call web which is ready, and that Manoj Almachandani wanted me to announce because I am also taking care of the BFSI in that think tank webinar. So I take great pleasure in the presence of all our panelists and participants to launch the web of WWB .thinktanks.co and .in. So this is every Saturday there is a very important webinar from 10:30 to 1:30. All the professionals who would like to see that will be available in their what you call YouTube, as well as they send the Zoom connection. With this, I now request Lion Vijay Maya, my good friend, very enthusiastic and very enterprising Lion, worked both at the district level and the multiple level, and in every level internationally got appreciation for his activities. So Lion Vijay Maya, your vote of thanks. Vijay Maya?
Let me come out of my dream world first. Yes.
Yeah, please continue. Yeah.
Dear Chairman, my dear Governor, Dr. Geet Prakash ji, my mentor, Dr. Narendra sir, and all the esteemed panelists. First and foremost, it's my part and my parcel of my duty to place it on record my best complimented thanks to the moderator, Dr. M. Narendra sir. Sir, the movement, the programs of Lionism connecting into finance. I am a civil engineer, and usually we civil engineers are very bad in economy, taking the money and all, and calculation and saving it is a different. If you have a better off, only that can be done. We never knew the economy, the financial aspect is not about complication. There are so many segments in it, and the stalwarts who are there Sharing a stage, sharing a platform with them, it itself is a fortune of the highest level, sir. And it has been made possible only because of you. This one of those days where it has given me so much of inputs that it's a basic duty of a common man to have some knowledge about your finance, some knowledge about the budget, in the interest of the society, in the interest of the self. The different avenues, the different departments, the knowledge, the deep depth with which they have gone, and the addressing of that each and every area, it has really stunned me. And I know finance is a very, very critical matter, but I never knew it's got so much of depth. And it was quite interesting also listening to it, and being a part of this great 2.5 hours of program is one of the finest days of my life. And first and foremost, moderator, my mentor, Narendra sir, thank you very much for all these things what you have done. So definitely this year of youth empowerment will, as already has made its own mark, signature with signature programs, as governors was every time telling, and you are the main reason for that, sir. The Governor, Dr. Git Prakashi, thank you very much for such an opportunity, and you have been there. So this February and March, it has been a governor's visit with continuous programs, 24 hours programs. I can understand what the things which is going on, but every time you make it a point to attend, and this is one of those programs you attended. You are there fully, physically, tanu, mana, everything. So thank you very much for your kind presence and gracious presence and kind words.
Thank you. Thank you.
Now, the list of all these people now, Anand Sinha sir, your address was so inspiring, and you are being a person with the main, the guidelines factor of this finance aspects of factors of this nation. Your experience was very much useful, sir, and your knowledge and your sacrifice, what you have done in securing that financial aspect of each and every person, highly appreciated. Sir, thank you very much, and compliments from each and every one of us. Shubhada madam and Anant Narayan sir, touching into different aspect of it, and you made your talk was so interesting, and I never sat for any of the economical activities to such an extent, sir. Your address and the positive and negative side of it. So don't be very complacent with some of the good things comes to you. Be ready for yourself for the negative things also. That makes you more stronger. One message from Anant Narayan has definitely, it is a caution. And with this regard of what your knowledge, your deep depth of knowledge, and definitely the way you took us in the different entire world of a layman like me into the world of finance and making it more interesting was very much entertaining, sir, and definitely. So on behalf of everybody, for your gesture, it's a deep depth of gratitude to all those people, Shubhada madam and Anant Narayan, and another madam was there, some Yovika, I forgot, sir, that lady was there with the PPT presentation. Thank you very much, sir. Kannan sir has already been there with us for your present Atmanirbhar Bharat, and it has given so much of Nirbhar, sir, Atmanirbhar. So your presence after about a gap of 1.5 months time, you are into a different role. Your presentation was different, and it was very, very knowledgeable exercise to us. And thank you for giving so much of input, your concern, your attitude, and all once again that passion towards knowledge assimilation is always appreciated, sir. Thank you very much. Looking forward to work with you more. Madam Deepti Deshpande, definitely another department, and with this young age, like the CRISIL is very, very big institution, and being a very big part of it, and the core competence of this financial aspect of the budget, the way you touched upon, definitely, and there are simple words and simplest words, and it has made us understand what this budget is all about, what finance is all about. Madam, thank you very much for your kind gesture and for addressing us, giving some knowledge to the laymen like us as far as finance matters is concerned. Sunil Goyal, sir, very, very impressive, sir. Very, very impressive. Being a large speaker is always a very challenging one, but whatever you spoke is not only about your magnanimous of your knowledge, but your experience, your positive experience. What actually mattered here is the positivity of your approach, with some concern. So always there, any process, you cannot be always positive. There are some non-positive things also where the way you touched it is that definitely impressed us. And this day where we just had some inputs of knowledgeable exercise on your finance aspect, you are one of the reasons for it. So thank you very much for your kind presence and all those great preparation, all those passion, and all those time of sacrificing in giving us some of those glorious moments of financial assimilation. Thank you to first Vice District Governor, our dear Vasant Shetty, and I could find so many other people. And special thanks to Sir Manoj Alim Chandani. Sir, definitely we would like to join hands with you regarding your knowledge sharing exercise, as Dr. Narendra was always mentioning your name, and my co-founder of Knowledge Partner Think Tank, definitely. So in that tank of thinking, we will all want to be a part of it in getting some experience of your vast world. So it has been a wonderful evening, a worth to spend. Definitely. The sky is the limit, sir, Narendra, sir. It is because of you what has happened. Now, all this, I could see some of the questions, and definitely I'm just gauging myself. I'm nowhere near any of these people, but still sharing a platform, being a student, as an observer, as a learner, that's given a lot of momentum for us, for me, definitely. Even though a immature level also, I take this great pride of sharing a platform, all of this with sharing some of my knowledge. Definitely, not going to be the last one, and these type of things should happen. So, in one word, thank you very much, ladies and gentlemen, and long.
And Mayaji, we'll ask all our panelists and all of them who can put the video on, and Praveen Udupa, or you can also take some of their photographs for our records.
Yes, yes.
Kindly take and please put all our panelists. Please be on the please put your video. Yes, take Praveen all their photographs.
So, Vasant Jyoti?
Yes, all of them should be there.
Praveen,
having spared the 2 hours time.
Sir?
Anant, you are there?
Yes, I am here. Very much.
Yeah, please take photograph. Yeah.
Vasant?
So Anand Sin also was there. Anyhow, yeah, Anand Sin
He's there. He's there.
Sir, anyone left, sir?
Yeah.
Anyone left?
Vasant Jyoti is there?
Vasant sir is not in the Zoom, sir.
Vasant Shetty.
Okay. Currently, who are available, Git Prakash also would have left, or maybe, but take the photograph. And I also acknowledge some of our media people are also there. And I hope some of the highlights would be getting in their own way in the social media. And I request all of the others who could not make it to see our YouTube in Ncube collaboration and have the benefit of knowledge. And even the presentation will be available through the YouTube. And if required, I think Subhada madam, some people asked for your presentation. I can take from you and send it to them. With this, once again, my greetings and good wishes, and thank all of you, and particularly our participants who are our inspired people, and with their inspiration, we do conduct this type of knowledge session. And Manoj Almachandani, that is also another platform, a global platform. So let us all work together. Thank you very much. All the best.
Thank
Good
you.
night.
Thank you. Thank you.
Thank you.
Thank you.
Good
Thank you,
night.
Narendra.
Thank you.
Good night. Yeah.
Good night. Good evening, everyone. Good night.